Okay, sorry about that. The software I use to record these videos, it only gives me a 15-minute time limit, so it kind of jumps up on you when you're talking, and it's also the only software that works for some reason with my microphone. So I apologize for that. We were talking about goodwill and intangible assets and how this is a red flag for me. As I said, say you have a building on the books for $500,000 you bought in 1920, it may really be worth 5 million. So having goodwill is not necessarily a bad thing. It's just kind of a red flag that it's not tangible value, but it may be a real value of what the company's assets are. So it's a red flag, but it's not too bad when you're buying companies that have been around for a long time, as General Mills does. They typically buy brands that have been around for a long time. Like they just bought a Yoplait in 2012. So that's it's just a red flag, just something to keep in mind and something you probably want to dig into. You don't want to see a company buying a whole bunch of other companies and way overpaying. I mean, that's anti-value investing, really. So just something to keep in mind and something you should be aware of. So as we said, when you look at their total assets, assets have grown from 18 billion to 21 billion. Again, most of that's in goodwill. So they're not really growing their asset base very much either. Take a look at their debt. One of my favorite things to look at. How are they using debt to finance it? And it seems like they have quite a bit of debt out there. Again, this is a concern for a lot of companies, but when a company has very stable cash flows, they can get away with using leverage to increase their returns on equity through debt financing, especially when you have that stable cash flow and you get very good interest rates on your debt. So we have current liabilities here. We've got some accounts payable and some short-term debt. Looks like short-term debt's actually coming down from the 2006 era, and it's been declining pretty steadily over that time, which is good. They're taking away their short-term debt, which again is much more risky than having long-term debt. When you look at a company and you want to match the debt load with the types of assets that they have. So if a company has a ton of long-term debt and or a lo- I'm sorry, a lot of long-term assets but a lot of short-term debt, that could be a red flag. That the company is financing its long-term assets with short-term debt, and that can be very risky if interest rates go the wrong way and they have to refinance at a higher rate. So we just want to make sure these are in line. It looks like they do have some long-term debt too. They've been steadily increasing their long-term debt as they've been decreasing their short-term debt. So their debt load is increasing slowly, and they have 10 billion in debt now, so they're using debt to finance their business and leverage the returns of the business, which can be okay, given their stable cash flow. I think that's one of the main points I want to drive home today, because I've talked about debt being this evil thing. It can be a nice tool, and it's something to keep in mind that debt should be in proportion to how safe the assets are. So utility companies typically have a lot of debt um, because their cash flow is stable, their income is stable because people are continuously using power. It's easily predictable. So debt's okay if it's in proportion with the lack of variability, inversely proportional to the variability of the cash flows. And then we come down to retained earnings here, and it looks like they're slowly retaining earnings and they're building up equity in the business. And this is also nice because they are also paying a nice dividend. Their dividend yield was been around 3% over the last couple of years. If we go back to the summary page, 2, 3, 2, in the 3% range, depending on the price of the stock. So they are paying a dividend out, and they're building up retained earnings for growth prospects as well. So that's okay. Let's look at income. How are we doing on the income statement? Are we growing revenues? They were at 10 billion in 2003, and we've got growth every single year. Not spectacular growth, 5.4%, 1.6, 3.5, 6.9. Nothing spectacular here. Their growth is nice and slow and low, but it's growth every year. That's a good thing. So we're seeing a nice slow growth company. This isn't a company that's going off the charts. Are they maintaining their margins? Are cost of revenues, cost of goods sold staying in line? 37% in the 40 in 2011, 35. So they're hovering in that range. They get about a 5-6% range on their gross income. It looks like they're maintaining their margins pretty well, and this is pretty important when you talk about the competitive nature of what they do. They're on these grocery shelves with their Cheerios right next to Kellogg's products. And people look at price a lot. People who, in economic times, they're very price sensitive on these things. So being able to maintain your margins gives a good indication that they have a strong brand out there in this very, very, very competitive marketplace where shoppers are constantly looking for the best deal. That's why coupons are so popular in this market, in the grocery market, because customers are very price sensitive, and the ability to maintain those margins is a nice thing to see for a company in that business. SG&A, as we said before, is pretty stable around the 20s, so we're okay with that. It's just very, very stable. Everything seems to be a very slow growth, very stable growth company. It looks like as revenues grow nice and slow, net income's growing nice and slow. So far what we're seeing here is a very, very boring company. Boring is good, as I said before. I like those nice boring companies, but I like them at a good price. So when we get to that, we'll see how good of a price they're going to give us on this. So let's go down to cash flow while we're talking about that. Cash flow, again, looks like it's pretty stable. We had a blip here in 2011 where it dropped a little bit, but that seems to be an anomaly. This line seems to be upward trajectory pretty stably, except for this 1 year in 2011, and then it just hopped right back up onto that normal line in 2012. So it looks like cash flow from operating activities is pretty stable. CapEx looks like it's growing at about the same rate as everything else is since 2005. 2006 looks like it's just been slowly chugging along, growing at a nice steady pace. So it seems like they're just managing the business nice and slow growth, growing with the economy, and that makes sense for a food company, especially one that's been out there for so long. They're just kind of doing their thing and moving along with what's going on. As for acquisitions, we talk about acquisitions in Oracle and how important that is to the business. I don't see it as important in a food business such as General Mills, where acquisitions are imperative for them to grow the company and to stay on the cutting edge. So this is more of a growth-oriented acquisition where they're buying other additional business. They're just adding to their portfolio. It's not something where Cheerios is now going to go obsolete because they bought Yoplait, which is what this $1 billion is here in 2012. Just because they bought a yogurt company doesn't mean that Yoplait or doesn't mean that Cheerios is gonna be obsolete, and they had to stay ahead of the game. So acquisitions here are a growth strategy for a company like General Mills, as opposed to a company like Oracle, where I see it as more a defensive measure and more like CapEx to stay ahead of the game. So how are we doing? Are we buying back shares? They are buying back shares. They're using their cash in addition to paying out a dividend. They are buying back shares. The net issuance of shares is pretty consistently on the positive side, that they're buying back more than they're issuing. So that's a good sign that they are buying back shares, and the slices of pie are growing in size in proportion to the whole pie. Looks like they really did a lot in 2008. This is very interesting that in 2008, when everything went down the tubes, General Mills got very aggressive on share buybacks in this 2007, 2008, 2009 period. This gives me a lot more comfort in the stability of the company. If you remember when we talked about Bed Bath & Beyond, I said I would really have liked to have seen them increase their share buyback in 2008 when everything tanked. Well, General Mills did that exact thing. They went from this 500 million, 700 million, up to $2.1 billion in share buybacks in 2008. And they maintained that through this recovery period where share prices were low. So they're very cognizant of buying back their shares at a low price, as opposed to just buying them back to goose earnings per share. It looks like they're very cognizant. I like that. That's a good sign for me, and something that I see as enhancing the stability of the company is that they even had the power to support their share price and increase shareholder value by buying back shares on the cheap. And as we look at the market as it's heating up and the market's getting higher and hitting all-time highs, their share buybacks have declined proportionally, which is a very good thing to see, that they're cognizant of the valuation of the shares they're buying back. Good stuff. What about debt? It looks like debt's going the other way. They're actually issuing more debt than they're buying back or repaying on a whole. So that back in the early 2000s, they were reducing their debt load, strengthening their balance sheet, making themselves more stable. But then in 2007 hit, they got really aggressive on buying back shares, but they also started to go out to the debt markets. It's not very significant. It seems like it's a rather small number out there. And in 2010, they went out and bought back a bunch of debt to again to strengthen out their balance sheet. You can see that this kind of is inversely proportional to, or it has an inverse relationship to the share buybacks. As they buy back more shares, they're issuing less debt, and vice versa. So that's okay that they're increasing their debt little by little. But again, I don't like it when a company increases debt. But this isn't out of line. Given the size of their company, it's not like they're going out and taking out massive amounts of debt. So I'm okay with it. And they're also paying their dividend. Looks like they are increasing the absolute amount of their dividend very, very regularly. In fact, it looks like dividends paid $400 million, more. Even through these dark days, they increased the amount of dividends that they paid. That's a nice sign that they're increasing their dividend on a very, very regular basis. And as they bought back more shares, that means that more of this dividend payment is going to go to you as an individual shareholder. So your dividend yield is going to grow over time. So I like to see how dividends are being paid and they're growing over a very, very steady rate. That's good stuff. Okay, so we've gotten through all the financial statements. We went through some ratios, and so let's get into what we see for our valuation. Okay, so let's clear all this out and refresh it. Let's start with free cash flow. So let's clear this out and refresh it. If you look at what the spreadsheet tells you right away, looks like fair value is 2241. Does that make sense? I mean, that's a pretty big jump. That's almost half of what it's at today. So what do we think of that? Do we think these assumptions up here that automatically get blown in by the spreadsheet make sense? Is 5.5% growth make sense? Is our discount rate right? Is our starting free cash flow period right? Is our terminal value right? So let's go through and see if these numbers make sense. Let's start with our 2012 free cash flow. So as we see, it's going to start here with this 1726, $1,726 million in free cash flow in 2012. If we look at our trailing 12 months, we've actually increased our free cash flow again. Again, we said this is a pretty stable company, so I think we can go with this. It looks like it's been growing over time. It's got some variability, but the trend line is upward. So I think we're okay with using somewhere in the middle here as our starting point, or we could even get aggressive and say this 1890-70 because they have been just consistently growing. So I think we can start there with our $1,890 million as our starting free cash flow point. Because we're pretty confident they're going to be stable. As we went through the financial statements, we think they're stable and they're just growing revenue every year, and income seems to be growing in proportion to that. So I'm good with starting with this number and getting a little aggressive on where we start with free cash flow. What about growth? What is growth doing? 5.5% seems extremely low for a company that's this popular and has this much market share out there. Can we really say 5.5% on a company like this? I could see 5.5%. That kind of makes sense to me, given what they do. As we went to their website, and let's just read through this. I think this justifies that growth rate pretty well. A box of Cheerios sits on the kitchen table. A cup of Yoplait yogurt rests in the refrigerator shelf, and sweet aroma of Pillsbury cinnamon rolls fills the room. It's breakfast time in America. Now, I read that and I thought to myself, does this make